This is an Uncovered Japan Company research report on Japan Lifeline, ticker 7575. Japan Lifeline is a Japanese cardiovascular device specialist that is officially labeled a wholesaler, but earns economics closer to a focused device maker. The central question is whether its entrenched cardiac procedure positions, strong balance sheet, and shareholder returns can carry it through a pulsed field ablation transition. The starting snapshot is unusually strong for a company filed under wholesale trade. Japan Lifeline holds roughly 95% domestic share in the BAT catheter used in atrial fibrillation ablation, reported a 21.3% operating margin in fiscal 2026, traded at about 12.9 times forward earnings in the report, and offered a 3.79% dividend yield. Those figures frame a quality business whose market label can obscure its economics. The business model is hybrid. Japan Lifeline develops and sells its own cardiovascular devices, including the BAT ablation catheter, the FET aortic arch stent graft, and the Vascade vascular closure device. It also imports and distributes selected OEM products, such as rhythm devices. The imported book provides scale and recurring hospital relationships, while in-house products provide the higher margin engine. Around 400 clinical specialists support physicians in a narrow cardiovascular focus, which makes the sales model more embedded than a conventional distributor's. The segment mix explains why the company can grow even when its largest legacy business is stable. Rhythm devices are roughly 30% of sales and declined 1.7% most recently, acting as the mature base. EP and ablation are around 25% and grew 14.8%, supported by atrial fibrillation procedures. Cardiovascular devices add about 15%, while neurovascular and gastrointestinal lines are smaller but have been growing quickly. The strategic mix is shifting toward higher growth, higher margin in-house products. Over fiscal 2022 through fiscal 2026, revenue rose from 51.4 billion yen to 59.2 billion yen. Operating profit grew faster, from just under 10 billion yen to 12.6 billion yen, a 5-year compound rate of about 6%. The report attributes this gap to the higher margin in-house product mix, operating leverage, and efficiency gains. The counterweights are a weaker yen on imported products and recurring reimbursement price cuts. Profit has converted into a notably resilient financial position. Fiscal 2026 net income reached 9.35 billion yen, while the equity ratio stood at 82.1%. The report identifies 12.5 billion yen of net cash and effectively no interest-bearing debt. That balance sheet flexibility matters because the company can fund research, TAVI entry, PFA development, and potential overseas expansion without relying on financial leverage. Japan Lifeline's moat is not broad consumer branding. It is mere total share in a few specialized procedures, where clinical trust and workflow knowledge matter. B8 holds around 95% share in its atrial fibrillation niche, and the FET aortic arch stent graft has more than 90% share. Vascade has exceeded 100,000 cumulative units. These are narrow markets, but their procedural depth and the company's specialist support help make them awkward targets for global competitors. Capital allocation is a material part of the case. Across fiscal 2022 to 2026, the report estimates 18 billion yen of dividends and 11.8 billion yen of buybacks, while the company retained 12.3 billion yen. Its policy combines a 40% payout ratio with a 5% dividend on equity floor, whichever is higher. That structure helps support dividends even in a lower earnings year, and completed buybacks have been canceled, improving per-share economics. Management's medium-term plan targets 70 billion yen of revenue and 145 yen of earnings per share by fiscal 2028. The road there rests on 3 pillars: an entry into transcatheter aortic valve implantation, or TAVI, co-development in pulsed field ablation, or PFA, and growth in overseas revenue. The plan is credible enough to watch, but execution is not yet proven. PFA is especially important because it could open a global opportunity while also disrupting the older ablation ecosystem. At the report date, the stock traded at about 12.9 times forward earnings, compared with a 5-year year-end average of 11.8 times. This is not a distressed multiple, especially because it uses conservative fiscal 2027 guidance. The valuation debate is whether the market should continue to treat Japan Lifeline primarily as a dealer, or eventually give more credit to its device maker-like margins, procedure positions, and growth investments. The report's 3-year scenarios are analytical illustrations rather than price targets. Its bear case reaches 1,300 yen, around 12% below the 1,475 yen reference price. The base case is 1,885 yen, around 28% higher. And the bull case is 2,720 yen. The range reflects earnings delivery and the multiple investors apply. A roughly 3.8% yield may cushion downside, but PFA disruption and overseas execution remain genuine risks. The concise conclusion is that Japan Lifeline combines narrow cardiovascular device moats, maker-like operating margins, a fortress balance sheet, and an unusually disciplined return policy. Its discount reflects a wholesale label, a transition year earnings outlook, and unproven overseas execution. The next evidence will come from PFA progress, TAVI preparation, international profitability, and the fiscal 2027 second quarter results. This is research for education, not investment advice. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.